On November 18th, 2021, the stock market witnessed something absolutely insane. A new fast food giant hit the trading floor, and for a minute, it looked like they had cracked the code. We're talking about Sweetgreen, the company that everyone was calling the Starbucks of salad. They were positioned as the ultimate modern brand. Healthy, high-tech, sustainable, and impossibly cool. Wall Street bought the hype hook, line, and sinker, valuing this salad chain at a mind-blowing $5 billion on its very first day. Investors were popping champagne, convinced that the era of greasy burgers was over and the future of food had finally arrived. But fast forward to today, and that shimmering $5 billion dream has turned into a total nightmare. The company is in free fall, fighting a desperate tooth-and-nail battle just to survive. But here's the thing, this spectacular collapse wasn't caused by some massive scandal or a sudden PR disaster. It wasn't even just because the economy took a downturn. The truth is much crazier. The entire empire crumbled because of a fatal flaw that was hiding in plain sight inside every single $16 salad they sold. A fundamental misunderstanding of how the restaurant business actually works. To really understand how hard they fell, we have to rewind to the optimism of 2007. Picture this, 3 college buddies at Georgetown University, Jonathan Neiman, Nicholas Jamit, and Nathaniel Rue, are sitting around dealing with the same problem every other student had. In Washington, D.C., you basically had 2 choices for lunch. Cheap, greasy fast food that made you feel terrible, or expensive, stuffy sit-down spots that took forever. There was literally zero middle ground. So these guys decide to fix it themselves. From their college dorm room, they hatched a plan to bridge that gap with fresh, farm-to-table ingredients served at fast food speed. They scraped together $300,000 from friends and family and opened up a tiny 560-square-foot spot in Georgetown. And let me tell you, it wasn't just a salad shop, it was a total vibe shift. They pioneered that clean aesthetic we see everywhere now. Exposed brick, cool neon signs, and those signature compostable bowls. But here's the genius part. They weren't just selling lettuce, they were selling a lifestyle. They were selling the idea of being a better, healthier, more conscious human being. They even launched the Sweet Life Music Festival, booking massive acts like The Weeknd and Kendrick Lamar. Think about that for a second. A salad company throwing a music festival. It created this cult-like following where carrying a Sweetgreen bag became a legit status symbol. It told the world, I'm successful, I'm urban, and I've made it. But just as they were conquering the lunch break, the big money started circling, and the vision was about to get twisted. Then the venture capital floodgates opened, and the whole narrative flipped. In 2013, AOL co-founder Steve Case's fund, Revolution Growth, dropped a massive $22 million investment. That was the exact moment Sweetgreen stopped trying to be a restaurant and started pretending to be a tech company. By 2018, Fidelity led a $200 million funding round that valued the company at over $1 billion. They were officially a quote, unicorn. Sweetgreen went all in on their digital platform, rolling out mobile ordering, dedicated pickup shelves, and delivery integration way before anyone else. By 2020, over half their cash was coming straight through their app. This digital-first strategy allowed them to demand what Wall Street calls a tech multiple on their valuation. Investors were treating them like a software company that could scale to infinity with zero extra cost. But they were ignoring a brutal reality. Unlike code, you can't just copy-paste a salad. They were dealing with perishable lettuce, avocado prices that bounced up and down like a yo-yo, and sky-high commercial rents. But the hype train was moving too fast for anyone to care about the details, and the founders decided it was time to cash in on the biggest stage of all. By the time the founders rang that opening bell on November 18th, 2021, the hype wasn't just loud, it was deafening. The IPO was an absolute smash hit. The stock was priced at $28, but the market was so hungry for it that it opened at $52 and closed at nearly $50. It seemed like the perfect company for the moment. In a world obsessed with wellness, climate change, and ESG scores, Sweetgreen checked literally every single box. It was tech-forward, eco-friendly, and had a fiercely loyal customer base. It looked like they were going to conquer the world, one kale Caesar salad at a time. But beneath that shiny surface, the math was already starting to break. The very thing that made their food taste good, sourcing locally for hundreds of stores, made their business a logistical nightmare. Think about McDonald's for a second. They use the same frozen beef patty whether you're in New York or Tokyo. That's how you get massive economies of scale. Sweetgreen, they had to basically reinvent their entire supply chain every single time they entered a new region. It was incredibly expensive and complex. They were trying to scale a boutique farm-to-table operation like it was a software startup, and those two worlds were about to collide hard. The mainstream breakthrough that everyone thought was inevitable, it was about to hit a massive brick wall. The first major cracks started to show in August 2022, and it was ugly. Sweetgreen dropped a bombshell, announcing they were laying off 5% of their corporate workforce and downsizing their headquarters. At the same time, they slashed their financial forecast, admitting that people weren't returning to the office as fast as they expected. The stock absolutely plunged. But the core problem was much deeper than just a bad quarter. The world had changed, and Sweetgreen was still playing by the old rules. Their entire business was built on the habits of high-earning professionals in places like New York and LA grabbing a quick lunch. But when the pandemic permanently shifted how we work, that sad desk salad culture evaporated overnight. People stopped going into the city every day. And for those who did go in, they were getting hit with massive inflation. Suddenly, paying $18 to $20 for a salad after taxes and fees didn't feel like a healthy choice. It felt like a luxury they couldn't afford. The premium salad became the first thing to get cut from the budget. Desperate to keep the tech company story alive and distract investors from the bleeding, Sweetgreen decided to double down on the most sci-fi solution imaginable. So in a classic Hail Mary play, Sweetgreen tried to innovate their way out of trouble with a massive bet on automation. Just before their IPO, they bought a startup called Spyce, founded by some MIT geniuses who had built a fully robotic kitchen. The vision was incredibly seductive. They called it Infinite Kitchens. Picture a restaurant where tubes and conveyor belts shoot ingredients into bowls with laser precision. The goal was simple: eliminate human error and, more importantly, slash labor costs, which are the biggest headache in the food biz. They opened the first one in Naperville, Illinois in May 2023, and they touted it as the future of food. But here's the thing about hardware. It's infinitely harder than software. The robot revolution didn't save them. It became a capital-intensive money pit. The machines were slow, they needed constant maintenance, and worst of all, they killed the vibe. It turned the warm, community-focused experience of Sweetgreen into a sterile, soulless vending machine interaction. While the company was busy chasing a sci-fi fantasy, their actual day-to-day business was bleeding cash. And just when they thought it couldn't get any worse, they started making unforced errors that made them look less like innovators and more like amateurs. Then came the legal drama, and honestly, it was straight up embarrassing. In April 2023, Sweetgreen decided to launch a new item called the Chipotle Chicken Burrito Bowl. I mean, seriously? You're trying to be the premium, high-end alternative, and you literally copy-paste the name of your biggest competitor? Chipotle didn't waste a second. They slapped them with a lawsuit immediately. Sweetgreen had to scramble and rename it the Chicken plus Chipotle Pepper Bowl. But the damage was done. It made them look like a cheap knockoff rather than an innovator. It signaled to everyone that they were running out of original ideas. And while they were dealing with that PR faceplant, the financials were turning into a horror show. Throughout 2024 and 2025, the bad news kept coming like an avalanche. Quarter after quarter, they were posting huge losses. Here's the dirty little secret that Wall Street finally woke up to. Despite all the hype and the billion-dollar valuation, Sweetgreen had never, not once, been profitable on a GAAP basis. They were burning cash to keep the lights on. The growth at all costs strategy had hit a wall, and even their top-line revenue growth started to vanish as they saturated the market. But if investors thought it couldn't get worse, May 9th, 2025 was about to prove them wrong. On that day, Sweetgreen reported something that sent a chill down every investor's spine. their first ever decline in comparable store revenue since going public. In retail, that metric is the heartbeat of the business. It tells you if your existing stores are healthy, and the diagnosis was critical. While total revenue was up slightly just because they opened new locations, the actual stores were making less money than before. That same day, they cut their financial guidance for the second time in less than a year. In the brutal world of Wall Street, cutting guidance once is a sin. Doing it twice is basically a death sentence. It screamed management incompetence. And the customers? They were revolting. Social media lit up with complaints about shrinkflation. People were furious, posting pictures of tiny portions and lower quality ingredients, accusing the brand of ripping them off. The reputation damage was severe. Then came August, and the floor fell out completely. The stock plunged over 27% in a single day after another disastrous earnings report. They announced yet another round of layoffs, cutting 10% of their support staff, which totally demoralized the internal culture. The company was flailing, trying to find a way out. But their next move only proved just how confused they really were. In response to the crisis, Sweetgreen started desperately foraging for a recovery plan, but honestly they looked like they were flailing. They announced a massive shift towards cost-cutting and simplifying the menu to save money. But then, in a move that made absolutely zero sense, they immediately turned around and promised larger portions and cheaper items to win customers back. It was a direct contradiction. You can't ruthlessly cut costs and give away more food at the same time. The math just doesn't work. It felt like they were throwing spaghetti at the wall to see what stuck. Then, in early November, the hammer came down. They posted a quarterly loss that was significantly worse than expected, 27 cents per share. Management tried to blame a, quote, challenging consumer environment, but the market called their bluff immediately. Why? Because competitors like Kava were absolutely thriving in the exact same economy. That proved the problem wasn't the market. The problem was Sweetgreen. Just days later, Wall Street completely lost faith. The heavy hitters like Goldman Sachs and TD Cowen downgraded the stock, basically admitting they didn't see a turnaround happening anytime soon. The share price, which had debuted at a glorious $52, had crashed all the way down into the single digits. Billions of dollars in shareholder value evaporated into thin air. But the final nail in the coffin? That came when they finally admitted their billion-dollar tech dream was dead on arrival. The robot revolution finally ended, and it didn't end with a bang. It ended with a fire sale. The Spyce robotics business, which was supposed to be their golden ticket to the future, was quietly offloaded. Sweetgreen sold the technology to Wonder, a restaurant super app, for $100 million in cash and stock. Sure, the cash infusion was necessary just to keep the lights on, but let's be real. It was a massive, public admission of defeat. It signaled to the entire market that the plan to fully automate their kitchens was a bust, and certainly not the quick fix they had promised investors. The tech company mask had officially slipped off. Following the sale, the reality check was brutal. Sweetgreen had to announce a much tighter outlook, slamming the brakes on new store openings to a rate of just 15% to 20% by 2026. Desperation started to set in, and the rumors got wild. Some analysts even started guessing that the company's survival plan might include adding French fries, steak, or even soft-serve ice cream to the menu. Can you imagine? That would be a tragic, total departure from their health-focused roots, effectively turning the Starbucks of salad into just another generic fast food joint. But while everyone was focused on the menu, the real poison was something much more fundamental that no amount of French fries could fix. So what truly went wrong here? The smoking gun is the price equation. They never actually solved it. Sweetgreen built an empire on premium, locally sourced ingredients, which naturally meant a premium price tag. That was fine for a while, but it totally alienated mainstream consumers the second the post-pandemic inflation hit. They were stuck in a brutal chicken and egg trap. They needed massive scale to lower their prices, but their prices were way too high to get the foot traffic needed for that scale. It was a loop of doom they couldn't break. Furthermore, the company was paralyzed by a massive identity crisis. Were they a tech giant or a salad shop? They spent millions building a proprietary tech moat that supposedly added value, but it distracted leadership from the unsexy basics of running a restaurant. hospitality, speed, and consistency. They treated the business like software, but food is physical, messy, and hard. They learned the hard way that the demand for $16 salads isn't infinite. It's highly elastic. When the price gets too high, people just walk away, and that realization leads us to the harsh truth about their future. Sweetgreen's loyal, urban, well-paid customer base was absolutely real. But here's the kicker. It was a niche, not a mass market. To justify that insane multi-billion-dollar valuation, they needed to be as ubiquitous as Chipotle, but they simply lacked that broad appeal. They are still trying to expand into new markets like Michigan and the suburbs, but the growth has slowed to a crawl because they're realizing a hard truth. Suburban moms do not spend money like downtown investment bankers. As of right now, the company is undergoing a painful, ugly pivot from a fast-growing superstar to a lean operator, desperately trying to prove it actually has a sustainable business model. Their story stands as a brutal cautionary tale about the dangers of hype and the quote at all costs mindset that infects Silicon Valley. It highlights the massive difference between having a good product and having a viable business. The concept of healthy, convenient food is noble, sure, but none of that matters if the unit economics are broken. Could Sweetgreen turn it around? It's possible. If they can broaden their appeal, fix their efficiency without destroying quality, and convince people there's real value there, they might find a path back. But that requires flawless execution, something they haven't shown in years. That's a whole lot of ifs. And in the unforgiving world of Wall Street, the clock is ticking. Thanks for watching my video to the end. If you want deeper dives into stories like these, and to be first in line to know about distressed debt, leveraged finance, and bankruptcies even before they're known to the public, you need to sign up for my credit newsletter.